Welcome to InvestorHubX.com. Every trader enters the markets hoping to find winning trades. But the professionals who consistently grow their accounts over years and decades are not primarily focused on finding winners. They are focused on not losing. Risk management is the discipline that separates those who last from those who do not. It is not the most exciting part of trading, but it is the most important. In this video, we will explore one of the most important concepts in trading, risk management. We will discuss why risk management outweighs strategy, why traders lose money, the risk-to-reward ratio, win rate versus risk-to-reward, position sizing, stop-loss strategies, risk per trade. If you find this video helpful, please give it a thumbs up and subscribe to the channel. Your support helps us continue producing high-quality educational content. Let's get started. If you ask a new trader what they want to improve, the answer is almost always the same. A better entry signal, a more reliable indicator, a smarter trading strategy. Rarely does anyone say they want to become better at losing less. Yet the mathematics of trading are unambiguous. A trader who loses 50% of their account needs to make 100% just to break even. A trader who loses only 10% needs to gain just 11.1% to recover. The asymmetry of losses means that keeping losses small is not merely important. It is the single most powerful action available to any trader. The legendary hedge fund manager Paul Tudor Jones once said, "The most important thing in trading is to preserve capital. If you are not in the game, you cannot win." Capital preservation is not a passive goal. It is an active daily discipline. So why do traders lose money? Most traders who fail do not fail because the markets are rigged against them. They fail because of a predictable set of behaviors that compound losses over time. Understanding these patterns is the first step toward eliminating them. The first pattern is trading without a stop-loss. A stop-loss is a predefined exit point that automatically limits your losses when the market moves against you. Trading without one is like driving without brakes. A small loss is a normal part of trading, but a large, uncontrolled loss can destroy your account. Always protect your capital before chasing profits. The second pattern is overtrading. Overtrading is taking too many unnecessary trades. It is often driven by boredom, impatience, or fear of missing out. More trades do not mean more profits. They often lead to higher costs, greater emotional stress, and poorer decisions. In trading, quality always beats quantity. The third pattern is emotional trading. Emotional trading is making decisions based on fear, greed, or frustration rather than analysis. It leads to impulsive decisions, poor discipline, and inconsistent results. The best traders follow their trading plan, not their emotions. The fourth pattern is revenge trading. After a loss, many traders try to win their money back immediately by taking larger or riskier trades. This usually leads to even bigger losses. Accept the loss, stay disciplined, and wait for the next high-quality opportunity. The fifth pattern is taking positions that are too large. Oversized positions increase risk and make emotional decisions more likely. A small loss can quickly become a major setback. Choose a position size that protects your capital and allows you to trade with discipline. The sixth pattern is ignoring the risk-to-reward ratio. Risking more than you expect to make is a losing strategy over time. Before entering any trade, make sure the potential reward outweighs the risk. Successful traders plan every trade before they click the buy or sell button. The seventh pattern is trading without a plan. Without a trading plan, every decision is made under pressure. Plan your entry, stop loss, profit target, and risk before entering any trade. A trading plan turns emotion into discipline. This is where a trading diary becomes extremely important. A trading diary helps you understand questions like, why did I take this trade? Did I follow my strategy? Was this actually a high-quality setup? What can I improve next time? That is why I create the InvestorHubX trading diary. Inside the diary, you'll find a trade quality scorecard where you can score every trade based on the factors we discussed in this video. You can record your entries, exits, emotions, mistakes, and trading decisions. Over time, patterns begin to appear. You may discover that your A+ setups perform much better than your C-grade setups. Instead of guessing, you begin trading based on data. Because the goal is not just to take more trades. The goal is to take better trades. If you'd like to learn more, check out the InvestorHubX trading diary below. Understanding the risk-to-reward ratio is the key to understanding risk management. The risk-to-reward ratio compares the amount of capital you are willing to risk on a trade with the potential profit if the trade moves in your favor. It is expressed as a ratio, such as 1 to 2, meaning you risk $1 to potentially make $2. The ratio is calculated before you enter a trade by identifying two key levels: your stop loss, which defines the risk, and your profit target, which defines the reward. Both should be based on technical analysis, not on how much you hope to make. For example, let's look at Bitcoin on the weekly time frame. Suppose you identify a bullish divergence on the weekly chart. After completing your technical analysis, you decide to enter a long position because the trade offers a risk-to-reward ratio greater than 2 to 1. To calculate the risk-to-reward ratio in TradingView, click on the Forecasting and Measurement tools and select Long Position. Next, place your stop loss below your entry. In this example, your risk is 10%. This means you are willing to accept a maximum loss of 10% if the trade moves against you. Then set your profit target at a logical resistance level based on your technical analysis. In this example, the trade offers a risk-to-reward ratio of 1 to 4.67. Let's assume you invest $10,000. If the trade hits your stop loss, you lose 10%, or $1,000. However, if the trade reaches your profit target, you make approximately 46.7%, or $4,670. This is why professional traders focus not only on how often they win, but also on how much they win compared with how much they risk. Many new traders believe that a high win rate means they will be profitable, but that's not always true. A win rate tells you how often you win. The risk-to-reward ratio tells you how much you win compared with how much you lose. Both are equally important. Let's look at the table. A trader with a 40% win rate can still make money because each winning trade is much larger than each losing trade. On the other hand, a trader with a 90% win rate can still lose money if the potential reward is too small compared with the risk. The lesson is simple. A high win rate does not guarantee profitability. Always consider both the win rate and the risk-to-reward ratio before judging a trading strategy. Position sizing determines how much of an asset you should buy or sell based on the amount of money you are willing to risk. Most professional traders risk a fixed percentage of their account on each trade, rather than a fixed dollar amount. To calculate your position size, you need three things: your account size, your risk per trade, your stop-loss distance. The formula is simple. Position size equals dollar risk divided by stop-loss distance. Suppose you have a $10,000 trading account and decide to risk 1% on a trade. This means the maximum you are willing to lose is $100. Suppose you buy a stock at $100 and determine your stop loss at $90. Since each share risks $10, you can buy 10 shares. Your total investment is $1,000. If the stop loss is triggered, you lose $100, which is exactly 1% of your account. Now suppose you buy the same stock at $100, but your stop loss is $80. Since each share now risks $20, you can only buy 5 shares. Your total investment is $500. If the stop loss is triggered, you still lose $100, which is exactly 1% of your account. This is how professional traders control their risk using position sizing. A stop loss is the price level where you exit a trade if it moves against you. It is the foundation of risk management because it determines your position size and the maximum amount you can lose. A stop loss should always be based on technical analysis, not on emotions. For a long trade, it is usually placed below a key support level or a recent swing low. For a short trade, it is usually placed above a key resistance level or a recent swing high. Risk per trade is the percentage of your trading account that you are willing to lose on a single trade. Most professional traders risk only a small percentage of their account on each trade. A common guideline is 0.5%, very conservative. 1%, recommended for most traders. 2%, more aggressive. 5% or more, high risk. The 1% rule is popular because it allows you to survive a series of losing trades without causing significant damage to your account. If you are new to trading, start with 0.5% to 1% until you have a proven strategy. The goal is simple. Protect your capital so you can keep trading tomorrow. If you find this helpful, please visit InvestorHubX.com for more lessons just like this. We are building a complete learning platform designed to help investors like you master technical analysis, stocks, cryptocurrency, commodities, precious metals, property investing, and more, step by step. You will also get access to custom indicators and in-depth video courses to support your learning journey and take your skills to the next level. To summarize, in this lesson, we explored the fundamentals of risk management, the skill that separates successful traders from those who consistently lose money. We learned why risk management outweighs strategy, the common mistakes that cause traders to lose money, and how to use the risk-to-reward ratio to evaluate every trade before entering the market. We also discovered why a high win rate alone does not guarantee profitability, and how position sizing, stop losses, and risk per trade work together to protect your capital. Remember, successful trading is not about winning every trade. It is about managing risk, protecting your capital, and staying in the game long enough for your edge to work. Risk management is not about avoiding losses. It is about ensuring that no single loss can prevent your long-term success. If you found this lesson helpful, please give the video a thumbs up, subscribe to the channel, and turn on notifications for future lessons. I will see you in the next video.